Hello, everybody, and welcome to our presentation on costly mistakes in life insurance planning. I want to thank everybody for joining us today for the ASA presentation. We think this is a very valuable presentation for you and your clients. One thing we particularly like about it is full of real life case studies and examples of how not to do something and then how to do it right. So we're very excited about it. Once again, thank you for joining us. We're going to spend about 30 minutes together. The three thin threads of life insurance. If you attend industry meetings, primarily AALU, you'll hear this spoken about during the meeting, the three thin threads of life insurance, and what most industry lobbying groups try to protect. And that is under Section 101 of the Code, the tax-free receipt of death benefits. Under Section 72, tax-deferred inside buildup of cash value. And also under Section 72, the tax-favored access to the cash value. Life insurance has FIFO taxation. And what that means is that the investment in the contract are recovered first. So when you hear withdrawals and then switch to loans at basis, when you're designing an illustration, this is what we're talking about. And these three items are essentially tax preference items. We don't look at it that way, but the government, Congress, looks at this as a preference. In other words, something they're giving us. And it is the benefits of life insurance that we need to work very hard to protect. The first big issue that we want to discuss is the Goodman Rule. A lot of you have heard of this. Some people call it the unholy triangle or the unholy trinity. I call it avoid this Bermuda Triangle. It's been around a long time, as you can see, 1946. It's really fairly simple to understand, but we see it violated quite often. So two things, right? Every insurance policy's got an owner, an insured, and a beneficiary. And if you want to avoid adverse income, estate, or gift tax consequences, only two individuals or entities should be named as the owner, the insured, and the beneficiary. So we're going to go through multiple examples of Goodman Rule violations in a personal setting, but also in a business setting. Okay, very common, very common planning with a business owner. Two business owners, they want to do some continuation planning, so they come up with a cross purchase buy sell agreement. As you know, a cross purchase buy sell agreement is where owner A and B, in our example, enter into an agreement with each other, and at one of their passing, then the survivor buys the stock from the estate of the deceased partner. Very common agreement. And here's what they do. So owner A buys a $3 million policy, excuse me, on owner B, and then just to keep things simple, names B's spouse the beneficiary. And owner B does the same thing. Owner B buys a $3 million policy on owner A, and then to keep things simple, names the beneficiary of the policy the spouse of owner A. And so what happens? Well, at death, whoever passes away, the survivor essentially makes a $3 million taxable gift to the other person's spouse at death with no strings attached. So it is just like if B passed away, if A had written a check to B's wife for $3 million, free and clear. Now, of course, that would be a taxable gift, and it would come off of A's lifetime exemption amount, but that's what it is. So what owner B's spouse says at this point is, hey, thanks for the 3 million bucks, but now where's the 3 million for my stock? So that exchange does not trigger B's estate having to turn over the stock, because essentially they were named beneficiary of the insurance policy, and it's just like getting a gift. What should they have done? Well, what we all see is more common. Owner A buys a policy on B for 3 million and names owner A the beneficiary of it, and B does the same thing. So in this case, if B passes away, then owner A gets the $3 million and says, okay, we're going to execute this written agreement. I'm going to write you a check for 3 million, your estate, and your estate, in consideration of that, is going to turn the stock over to me. And now, in this case, owner A would own 100% of the company. It's a tax-free exchange, and everybody is very happy. Let's look at another example of an entity purchase. Well, as we all know, now the agreement is between the business, so Acme, and both A and B. And in an entity purchase, that means the entity is going to buy the insurance. So here's what happens. The entity buys a policy on A and a policy on B. And once again, a lot of times what we see is, to keep things simple, they would just name the spouses of each partner the beneficiary of the insurance on their life. At death, the spouse of the insured that passed away would get a check for $3 million, and that check would be either taxable as a dividend or compensation to the surviving spouse, and Acme would still owe $3 million to execute the buy-sell. So the surviving partner would be very unhappy at this point. Now, the deceased partner's spouse that got the $3 million death benefit that was taxable, probably not going to be real happy either for having to pay income taxes on that, but they are getting a windfall in this situation. And it's just, you don't just name outright the spouse the beneficiary unless you execute this in the context of let's just say, an endorsement split dollar plan, and you follow all the rules of an endorsement split dollar plan. But in this case, the rules were not followed. So what should we have done? Well, what Acme should have done was buy a policy on A and B, which Acme did in the first place. But now Acme names Acme as the beneficiary. So now at death, Acme is going to receive $3 million tax-free. Acme is going to pay the surviving spouse $3 million in exchange for the deceased owner's stock. Everything's clean, and it is a tax-free exchange of money for stock. This is something that we see really quite often, estate equalization. So let's say you have 3 children, and one child has invested their sweat equity in this business for quite a long time. I mean, they are a part of the business. The other 2 children don't have anything to do with the business. It is an issue because the business is worth quite a bit of money. So what the parents have said is, listen, when we pass away, child A is going to inherit the business. We're going to pass this business to child A, because they've really done all the work, and now they're going to have all the risk of running this company. And so what we feel like is that equitable doesn't mean equal. So what they're saying in this situation is, we think if we give each one of our other children a 1.5 million each, then that's equitable. And the other in exchange for child A receiving the business outright. So what the parents do to keep things simple is make child B the owner of the policy. Maybe they're older. Maybe she is more responsible than child C. Whatever it is, that's what they did. And then they name the beneficiary both B and C. So what happens there? Well, at death, what happens is it's considered a taxable gift from child B to child C for half of that death benefit, or 1.5 million. And that consumes part of Child B's lifetime exemption equivalent. You may not think that's a big deal because right now the exemption is about 11 million a person. But remember, in 2025, the Tax Cut and Jobs Act provisions relative to the lifetime exemption are going to sunset. It's going to go back to the law where it was, and we think it's probably going to go back in 2025 to around 6.5 million. So if you lose $1.5 million of 6.5, and then you consider there's an inheritance and maybe some growth, it could be an issue. Another issue is the premium from the owner to the carrier only partly qualifies for the annual exclusion. To qualify for a $15 million annual gifting exclusion, it has to be a present interest gift. And if Child C does not have the right to reach in that policy and pull their share of that money out, because Child B actually owns the policy, and Child B's probably not giving Child C a crummy letter or telling them about it, or they may not even know about it. So it's just not real clean. What could you have done? I mean, you could have you could have set up a life insurance trust and made this whole thing a little bit cleaner. Okay. Moving on. Yeah, well, let's say we name Child B and C the owner and Child B and C the beneficiary. That works. It's still maybe not clean. Let's think about risk. Well, Child B and C could get divorced from their spouse, and that policy is considered part of their property. Could be an issue in a settlement. Child B and C are subject to litigation risk. They're subject to liability risk, and these policies are assets in their estate. So if you really want to make it the most clean way possible and you want to protect those proceeds from predators, creditors, ex-spouses, all of those things, put it inside of a life insurance trust. It's a much cleaner way to do it. How about key person insurance? Let's just say we've got the owner is a key person and they need a $6 million policy. Now, key person normally is, hey, we're going to replace you. It's going to cost us some money to recruit somebody, maybe pay them a signing bonus. If you're using the insurance for debt protection, the rules are sometimes a little bit different than quote unquote true key person insurance. So let's just say the company needed $3 million on the owner's life for whatever reason. And they bought a $6 million policy. And in exchange for that, they named the beneficiary, the spouse, half of that policy. So they bought 6, only needed 3. So just named the spouse the beneficiary for half of that policy. What have you done? Well, at death, that essentially is $3 million of compensation to that spouse. And whether it's going to be W-2 compensation or a dividend, we'll let the CPAs figure that out because a lot of other factors come into play. But what we are sure of is that it would be compensation. Not a good situation. So what should you have done? You could have entered into an endorsement split dollar and endorsed half of that out and followed the rules, the split dollar rules. And if you'd done that, we would have been just fine. Okay. Look, this is a value add conversation when you're speaking with your business owner clients. The loss of step up in cost basis is the most common mistake in buy-sell planning. So the loss of step up in cost basis is the most common mistake in buy-sell planning. There's a really simple prospecting question to the owners. You would say, hey, if your partner passed away, would you consider selling the business after they had passed away? And if the answer is yes, I definitely would. Once I owned it outright, I don't know that I would want to run the company by myself. I might want to sell it to somebody else. If that's the case, you want to make sure when either partner passed away, the survivor received a step up in cost basis for the purchase of the deceased stock. Because in the event of a sale later on, that's going to save them a lot of money in capital gains taxes. So let's look at the two most common types of buy-sell agreements: entity purchase and cross purchase. In an entity purchase, C corporation, the surviving shareholders do not receive a step-up in cost basis. So if you have a C corp entity purchase and they think they might want to sell it, you want to make sure and discuss the cost basis step-up issue with the owners and their tax and legal advisors. How about an S corp? Well, a surviving shareholder may receive a step-up. You have to follow some particular types of tax accounting. There are some procedural things that would need to be done in the year of the death of the shareholder. And you want to make sure that their tax and legal advisors are comfortable with that process. And if they're not, then you need to consider something else. LLCs, surviving shareholders can do what's called a special allocation. And they can, when they make a claim for the proceeds, they can allocate the proceeds when they come into the company to their capital account, which essentially gives them a step up in cost basis. Keep in mind, when you pass away, your estate automatically receives a step up. This is for the deceased, and the survivors for the deceased. Their stock automatically gets a step up equal to the fair market value as of the date of death. What we're talking about here is step ups for the survivor, for the surviving owner. Now, cross purchase, the surviving shareholder is going to receive a step up in cost basis. So, but what is an issue with a cross purchase? If you have more than two owners, it can get a little complicated. However, there is a pretty good strategy called an LLC option, where the LLC essentially becomes a bank, and it is a receptacle for receiving life insurance proceeds to fund cross purchase agreements when you have multiple shareholders, meaning more than two, or you have multiple business entities owned by the same shareholders. And so an LLC as a substitute essentially becomes the bank to receive cash is a nice solution in those instances. All right, we are going to step off into supplemental retirement with life insurance. This is more of a costly mistake. Well, first of all, for the person who's selling the strategy, and secondly, the person who's buying it. We have on the right the tax triangle. All that means is when you retire, you're going to have multiple buckets of money, and they're all going to be taxed a little bit differently. So why would someone use life insurance to supplement their retirement income? And the reason is simple. It's income tax diversification. Life insurance provides another bucket of wealth that is taxed differently than most other buckets of wealth that people have. And so, but when you're doing it, you need to make sure that you fund the policy and design it the right way for the best interest of that client. So what do you do? Well, first of all, fund that policy to maximize the internal rate of return on the cash value. What that usually means is you'll go option B to A. So option B during the accumulation phase, switch to option A when you're going to start pulling out money in the policy. We all know that that's the proper design. Hey, it does a couple of things. It makes the cash accumulation in the first year really a lot higher. It does minimize to some extent the commission, but if you're doing the right thing for the client, then that's a good trade-off. Illustrate conservatively. You don't necessarily have to show the maximum AG 49 look-back rate to do this and make this strategy work well. What you have to do is explain to the client why you're showing this thing at 5 or 6%, and that you could have probably illustrated higher, but you felt like if you illustrate conservatively and it looks good, then when you have ups and downs in the market or the indexes, if you're using an index UL, then the client is got a likely chance that what you're showing is actually going to happen. This is kind of an old test, been around a while. Is the cost of the insurance less than or greater than the cost of the tax? All that means is we know that insurance has a drag on it. It's called the insurance costs, and that's a drag on the performance. However, if you weigh that cost, which could be 1%, 1.5%, 2% over the life of a policy, with what the tax rate is, the income tax rate is when you're pulling the money out. So if you pull out 50, it's almost like pulling out 70 on a taxable basis. So is paying that cost of insurance worth saving the tax bracket on the withdrawal if it was a taxable investment? And if you fund it the right way, you'll see that it probably is. The last thing is avoid a modified endowment. I think most of you would do this anyway. The carriers aren't going to let you sell a modified endowment in a LIRP or a supplemental retirement strategy anyway. A lot of you guys, this is an AXA Bright Life Grow illustration. Don't expect you to be able to read it. It's a little bit small, but there is one thing I want you to see in this illustration. The first thing is, it's illustrated fairly conservatively, but the second thing is 80 to 100%. What do I mean by that? If you'll notice, the cash value of the policy, not the surrender value, but the cash value is around $8,700. This is a B to A scenario, funded very conservatively. And when we do that, we've got 87% cash in the policy in the first year. Now, I think some people might argue with me a little bit, 80 to 100%. I mean, if you're using an institutional product or a product with a high early cash value rider, you might get up into the 95 to 100% range. But if you're using a typical retail product and you're just funding it from B to A and to the 7-pay guideline, then you should see around 80% or more cash value in this product the first year. Okay, is your employer-owned life insurance taxable? Some of you may have seen one of our other presentations on this and already know who that guy is. He's one of my favorites. His name is Carl. Carl is the janitor in the Breakfast Club, for those of you that grew up in the 80s. And so Carl's the guy that knew everything that was going on. Well, where this originally happened was Winn-Dixie owned, I think, around 33,000 policies on their employees. For a large corporation, it's very profitable to own insurance from an accounting perspective and from the fact that you get tax-free death benefit. But they also insured everybody. And so what would happen was Carl passes away. Carl's family's probably living hand to mouth. And Winn-Dixie gets death benefits on Carl's life and keeps it. And Carl's family doesn't get any of it. So this wound its way through the courts and Congress. And finally, what they said was, hey, you guys don't have an insurable interest on the life of your janitors. And we're going to pass a piece of legislation, Section 101J, was passed in 2006. And basically, it has the presumption that all corporate-owned life insurance is taxable, unless you have notice and consent from the individual that you're going to insure, and you insure somebody that is in an exception class. And you can see the 4 classes there: officer, director, highly compensated employee, or you pay the death benefit to the insured's family. When could that happen? Let's just say it was an endorsement split dollar plan. Or the person was employed within 12 months of death. So you could still buy insurance on Carl, but if Carl leaves your employment and is gone more than 12 months, it doesn't matter what you do, that death benefit's going to be taxable. So the solution there would be, if someone like Carl left, you'd probably want to give them their policy. Or used to purchase an ownership interest in the entity. So like for a entity purchase by sell agreement. But keep in mind, it's been around a long time. Not a lot of people are paying attention. It's not the carrier's responsibility to make sure 101J compliance is met. We help with that compliance responsibility at the ASA group. When you submit a case that is employer owned, we'll send out a compliance kit that has a sample notice and consent form in it, and so that you can get that done up front. It has to be done before the policy is issued. This presentation is a standalone 1 hour or 30-minute presentation if we're not doing CPE. And so we're going to send out a 101J audit sheet. So if you have employer clients, it's a great conversation. There's a form called 8925, and it's required to be filed every year. And so all you have to do is talk to your business owners and say, who's filing the 8925 forms for the employees that you own life insurance on, including yourself? And you'll probably get a blank stare. And then you just have to say, if you don't comply with this 101J and you collect death proceeds and you get audited by the IRS, more likely than not, those proceeds are going to be taxable. So that's kind of a disturbing question. And then the really neat thing is the cure is normally you have to rewrite the insurance. So it's good for you. It's good for the employer if you can help them, and you can save them a ton of money in the event of an audit when they don't have compliance. If you need more information on this, just reach out to sales at the ASA group, and we'll make sure that you get educated on it. All right. Well, I'm sure a lot of you who have followed the NBA for a while know who this gentleman is. This is Dikembe Mutombo. And what he was famous for in the NBA was when somebody would drive the lane to do a shot, he would swat it away, and then he'd wag his finger. Now, this was back in the days that you could do that without getting a technical foul for taunting, but that was what Dikembe was famous for. Well, other common mistakes: don't do this. Failure to review a policy every 24 months. Listen, no matter what, think about it. Since the last 25, 30 years, we've been a sustained falling and low interest rate environment. It has had a severe impact on policies that are subject to interest rate crediting rates. We have had some major market swings in the 2000s that have been devastating for policies that are linked to the equity market. Think variable life. And then the other levers, due to sustained low interest rates and carriers not being able to sustain the earnings that they had expected, we see things like cost of insurance increases out there. You should be reviewing your clients' policies every 24 months. Issues do not happen overnight in a life insurance policy. You can see them coming from a long way away if you do a policy review, and give your client a chance to do something about it. So it's kind of like a tsunami, right? We've all seen the pictures of people standing on the beach looking at that wave way out there in the ocean, and they don't do anything about it until it's too late. Well, if you do a policy review, you can do something about it before it's too late. How about failure to consider a life settlement before surrendering or lapsing unwanted and unneeded policies? Let's make sure we're all on the same page here. Unwanted and unneeded policies means just that. You bought the policy a long time ago. You no longer need it. You're probably going to lapse it. There are 9 states now that mandate that you are told that there may be another option. There's about $900 billion of face amount of life insurance lapsed or surrendered a year. $112 billion of that lapsed or surrendered by seniors. So, a lot of those policies, even an old term policy someone's going to continue, could be settled, and you could deliver some really nice checks potentially to your clients. What I'd like to do now is, of course, during the presentation, we have received a few questions in the chat box. So send us your questions via the chat box. We're going to answer them to everybody. We want to thank you for attending this presentation and look forward to having you on the next one. If you have any questions, what I'd like you to do is let's do a call to action. There has to be a case that you have thought about during this presentation that you've got a question about. I want you to reach out to our sales group about an opportunity that you might have, whether maybe it's a 101J audit or something like that. Reach out to sales and let's start a conversation about a live case that you'd like to discuss right now, and we'll help you in any way we can. We want to thank everyone again for joining us. Look forward to the next time, and everybody have a great, productive week. Thanks so much. Bye bye now.